Welcome, friends, to this Dirty Economics webinar on why the sudden rise in Fed rate hike bets and the impact on FX and equities. To begin with, if you go and check the CME website, uh, September rate hike bets are still somewhere around maybe 30-35%. Uh, you know, they in any case they are well below 50%. So don't just say that no, the Fed rate hike bets haven't gone up. What we are going to discuss is uh, the or should I say the title more rightly represents the action in the markets that we have seen today in the North American session. We'll take a look at what has happened in the North American session and what it is suggesting, uh, while taking into consideration the broader picture. And then we'll go on to look at the have a look at the major markets, from the technical viewpoint and fundamental viewpoint. So let's begin with the first and the only slide. Maybe are markets preparing for a Fed rate hike? Looks like so, because if you look at the markets right now, dollar has strengthened across the board. I guess the worst currencies are the Aussie dollar and the New Zealand dollar, and you also have British pound trading under pressure. You also have Japanese yen down. But look at the second point. What we see right now is a sort of a classic risk-off action in the markets. That is, Dow is down by more than 1%, and yen is down against the dollar as well. However, yen is outperforming most measures, which means that AUD JPY is down, NZD JPY is down, GBP JPY should be down. Euro also being a sort of a funding currency, it's holding up well, and it's holding up well. The another reason is that Draghi was reluctant to move rates or do more QE yesterday, and the message that comes from the message that came through from the ECB event yesterday was that the monetary policy has reached a sort of exhaustion, and central bank chief Draghi, and not only just Draghi, but most of the central bank chiefs across the advanced world now want to see more of a fiscal effort, and so the currency is holding up well, and that is the bearing the action in the euro. If you look at the yen crosses, most of them are down, which suggests that the classic risk off is underway, and the you might be tempted to blame the North Korea, nuclear test for all this, but uh, the traditional safe havens weren't really doing anything. Gold prices were largely flat in the Asian session today after the news of the nuclear test broke out, and even the Japanese yen, it added few pips against the US dollar in Asia. It dipped to 102, but then went on to clock 103 levels in the US session. And yes, rightfully so. The reason is the hawkish comments from the doves, that is the traditional doves at the Federal Reserve. Like Rosengren was on the wires today, mm, talking, a little hawkish. And the last point, it's just a broader picture that Bank of Japan and European Central Bank are both reluctant to do more now, and thus the entire situation is such that uh, most of the central banks stand exhausted, most notably Bank of Japan and ECB, and due to that, there is less pressure on the Federal Reserve, because if we had more rate cuts by ECB or Bank of Japan, or if they would have hinted at more easing, then that becomes difficult. Then that is sort of a problem for the Fed, because then Fed alone cannot risk moving in the opposite direction. Now that these central banks stand exhausted and are just reluctant to do more, uh, and plus you also have Fed officials coming out hawkish, the entire picture suggests like maybe we may just have a rate hike in September. Never know. And as I said, rate hike bets, if you check the rate hike bets on the CME website, they are well below 50%. But the reaction today, that the action today which we have seen is it tells me that markets somewhere markets do see a risk of rate hike in September. They're not convinced, but they fear, and that fear is being reflected in the market moves today. So that is the reason, the title of the slide goes, "Are markets preparing for a Fed rate hike?" Yes, indeed. The action seen today that we just talked about, they represent, uh, markets pricing in a possibility of rate hike in September. So let's go on to look at some charts now. Let's begin with euro dollar pair, and it's, as we can see, it's trading around 1.1214. It was holding up well earlier today. It was up, it went up to around 1.1285, but then, eventually it fell back to 1.1213 levels. When you view this chart, chart, take the note of the hammer candle over here, and it's a long upper shadow followed by a bearish follow through, and that tells me that we could be heading lower to around 1.1123 levels by next during the next week. Also look at the euro JPY pair. What we have is an inverted bearish hammer candle, and if we have a bearish follow through on Monday and subsequent break below 113.81, then the doors would be open for a drop to 112 levels. If we go to USD JPY pair, it's interesting. The chart is interesting. Let's switch to the 4 hour chart. What we have here, if we zoom in on the chart, what we have here is we have this big inverse head and shoulder kind of formation, and the right shoulder is being formed now, and the breach of the minor falling trend line resistance add credence to the view that we could be heading higher towards 105 levels. And now, especially now, the stage looks set, because markets are fearing a Fed rate hike. We are likely to see, the long duration bond yields in the US spike, and that would pull dollar yen higher. So, from here, I guess the 103.40 is a major resistance, and above that, I guess the doors would are open for a rally to 105 levels. Next on tap is pound dollar pair, and pound dollar has failed to, really capitalize on the positive data that has been released over the last couple of weeks. Throughout August, we have had July data suggest there is no signs of post-Brexit gloom and doom. And right now, if you have a look at the chart, it's a classic kind of a bearish pattern on the daily chart. Uh, we had a breach of the falling trend line, and the pair retested the falling trend line and then spiked. But what happened next? So what we have essentially is a rising trend on the chart, followed by a big bullish candle. The big bullish candle is followed by a big bearish candle, which retraces, which closes well below the 50% retracement of this positive candle, and so that is nothing but a dark cloud cover formation as per the candlestick study. And then we also had a bearish confirmation yesterday, and the candle closed well below the Tuesday's opening price, and so it's just a clear sell signal here, and prices are likely to extend the retreat to around 1.3059 levels during the next week. On the higher side, what we need to watch out for is a day end close above 1.3445, in which case, we could go higher to 1.3641. Also take note of this trend line. If we just extend it, the support comes around 1.3223. So in case we rebound from here on Monday, or if we rebound from 1.3230 or so, and the rebound is followed by a break above 1.3315, which is the 23.6% Fibonacci retracement of 1.5019 to 1.27789. In that case, we could once again revisit 1.35 handle. But as I said, bearish invalidation is seen only in case of day and close above 1.3445. And if we do see a day and close above 1.3445, stage is set for a rally to 1.3641. The bullish break in GBP USD, it would be a good opportunity to trade GBP AUD, GBP NZD on the longer side, because both of the currencies are taking a beating against the US dollar. And if the rate hike bets spike even further, I guess the commodity dollars are going to take a hell of a lot of beating, simply because they have been the biggest beneficiary of the yield differential, as and how the Fed rate hike bets dropped over the last couple of months. The flow of money was directed more towards Aussie and the New Zealand dollar, simply because they offer a substantially higher yield compared to its European peers, or Japanese yen. And so if the Fed rate hike bet spike and the long end of the treasury yield curve begins to treasury yield curve begins to rise, the fund flow would be directed back to US, and that would create a serious drop in the Aussie dollar, US dollar, and Kiwi dollar, US dollar pairs. And in such an environment, if we see GBP holding well, scoring a bullish day and close of 1.3445, that would be a good opportunity to go long on pound New Zealand dollar and pound Australian dollar. And let's have a look at the gold chart. So again, what I have here is a monthly chart on gold, and as we can see, the price is stuck at the falling trend line for the last 2 months, and it's once again struggling to breach above the trend line resistance. Breach the trend line resistance. The monthly high stands the current month's high stands at 1352. The trend line resistance stands at 1345. So what it means is that we had a look above the trend line and we have retreated back. However, it's still early to call a top here. As long as we do not see a day and close below 1300 levels, there is always an opportunity that the metal could go higher. And when we look at it on the daily chart, it tells us it might be forming a sort of triple top formation. So this is the first top. We made a second top again here. So the tops are declining, and so it forces me to think whether we're going to see a bearish break from from this consolidation pattern, or falling. I'm sorry, a triple top pattern. Whatever one may call it, but it looks like as if prices are heading down to 1300 levels. Coincidentally, the neckline level or the channel support also comes around 1300 as of now, and that's also the 100-day moving average level. So once we breach 1300, I guess it would be a free fall to 1250 levels, which coincidentally, by then the 200-day moving average would have shifted to around 1250. So below 1300, we need to watch out. The next level that we need to watch out is $1250. On the higher side, I need to see. I want to see a clear break about $1380, which is the 38.2% Fibonacci retracement level of the move from 2011 high to 2015 low. And we tested the area around $1380 once in early June, and then another attempt was made in early August or so. We can see multiple daily candles in June, and we can see multiple daily candles in early August. But the net result was, we failed. I'm sorry, it's not June, it's July. So we made multiple attempts in early July and early August, but we failed, and so we have resumed the retreat. So overall, it appears that the metal is heading back to 1300 levels. But as I said, the bullish invalidation is seen only in case the metal sees a day and close below 1300 levels. And what we do next is we'll have a look at the Dow Jones index. As we can see, a big fall is seen today. The index has been offered heavily below 50 DMA. However, the 50 DMA is still rising. So I'm not really. Uh, I don't somehow just going by the technicals. It seems as if uh, weakness would persist, or but we are unlikely to see a serious fall uh, unless the 50-day moving average tops out. There are no such signs as of now. Uh, on In fact, we can also see a sort of a head and shoulders formation on the daily chart, and it's looking quite good here. And we have a breach of the head and shoulder formation. The neckline support was around 18,300, and the head and shoulder high stands at 18,668. So it's roughly 350 points, and that means we could go to 17,900, 17,950 levels, which takes us below the 100-day moving average. So that's an interesting chart here. Major support is seen around. This major support is seen around the same level, 17,928, 17,950. So that's a critical level. That's not only a head and shoulder target, but it's also the rising trend line support. So bears need to watch out for a rebound from these levels, because such a move could take us back to head and shoulder neckline level of 18,320. And the retreat to the trend line level appears likely, especially if the markets continue to fear a September rate hike. If we put Fibonacci retracement level, there's another interesting point to note, and that is we have breached the 23.6% Fibo retracement of the move from post-Brexit low to post-Brexit high. And what my experience says is that uh, anytime an index or a stock or uh, currency pair or commodity, it completes 23.6% retracement, it on most occasions it goes on to test the 38.2% retracement level as well. So what we have here is increased prospect of a drop to 18,055 levels, which is the 38.2% Fibo. But and further losses. So at least as of now, it seems that we are likely to go lower at least to 18k levels, and a strong support is seen around 17,928, 17,930 levels or so. So these are the key levels to watch out in Dow Jones. And the FTSE 100 chart is somewhat similar as well. When it comes to the daily chart, especially, it has a head and shoulders pattern as well. There seemed to be some error here. So that's pretty much for now. And okay. So the chart has just worked, and let's see what it says. FTSE 100. Once again, the daily chart, and as I said, it's pretty much the same, because we have a head and shoulders over here as well, and the index almost tested the neckline support, which coincides with the 50-day moving average level of 6753. So if we have had a day and close below this, we could have revisited the area around 6600, the day and close below which would open doors for 6430, 6400 levels or so. But as of now, we have not had a bearish day and close, and which leaves the doors open for a rebound from the neckline level. Also note the 50-day moving average. So the Monday's candle would be interesting. What I have usually observed is that when the index or stock nears such a critical technical level, the next day it dips, it prints a low well below the support, and then the candle just comes up and it ends up forming a bullish hammer, and that, for me, that type of a candle at critical support levels is extremely bullish. So I would watch out for that. If we see a candle, a bullish hammer candle over here, the index drops to lows, then recovers, and the main body forms above the head and shoulder neckline, then that would be a very, very strong buy signal. So right now it's just a wait and watch game. So that's it for today, and I'll catch you next week. Thank you.